right. Good afternoon, everyone. Second year in a row, Whitaker-Myers Wealth Managers tax webinar, where we're going to actually spend today focusing on two critical topics that we think are important, especially at the year end. And Kage got a little sick last week, so we had to push this back a week, which almost makes this perfect because it's the day before the year end, the point in which you definitely have to start thinking about preparing for the 2024 tax season and focusing ahead towards 2025. And that's what we're going to hit on today. I'm John Mark Young, and it's my privilege to introduce to you our two expert speakers we're going to have on today's webinar. The first of which is we have Kage Rush of Whitaker-Myers Tax Advisors. Kage is a CPA. He's going to guide us through the key updates, strategies, and insights you need to optimize your 2024 tax preparation, whether it's navigating, recent tax code changes, identifying deductions that you might not know about. Kage and his team are here to ensure you're equipped to file with confidence and accuracy and to make it as easy as possible to do your tax return. One of the things that used to drive me bonkers was thinking about all the stuff I had to do to get my tax return done and all the hours it would take and when I was going to find that time. In today's world, with somebody like Kage, he can get it done, his team will get it done cost effectively, and we appreciate his knowledge that he's going to share with us today. But also joining Kage is Tim Hilterman. He's a certified financial planner and has his CAP designation, which we're going to put to great use today. Tim is our Chief Financial Planning Officer here at Whitaker-Myers Wealth Managers. He's heavily involved in a lot of the financial planning that our team does on a day in and day out basis. And he's going to take us beyond tax preparation, and Tim will dive into the exciting possibilities of maximizing your charitable giving, which is something that probably most of you on this call do in some way, shape, or form, but maximizing your charitable giving using something called a donor advised fund, which will help you potentially save taxes, potentially get out of capital gains taxes with certain assets. And he's going to explain how these funds can help you make a significant impact for the kingdom of Christ, pushing the gospel forward, or any of the other causes such as Samaritan's Purse, Tunnels for Tower, whatever things you care about, while also creating valuable tax advantages for you and your family. You don't give for the tax advantages, but you certainly take advantage of them when you can. So together, Kage and Tim are going to bring you a wealth of knowledge around this conversation, and we're excited to provide you with actionable strategies to make the most of your financial opportunities in 2024 and beyond. And of course, we would be remiss if we didn't take this opportunity at the end of the year where we think about all the things we're grateful for. Most importantly, we're thankful for Jesus Christ coming and being born on this earth and living this perfect life to atone for our sins. But as we think about our professional lives, we are so very blessed and thankful for you, our valued clients who are either joining this webinar live or will be watching the replay of it on YouTube or Rumble. We thank you so much. We appreciate your trust in us. If there's anything we can ever do to make it better, you let us know. We're happy to do that. So with that being said, let's kick it off to our CPA extraordinaire, Kage Rush. He's got the most beautiful office in the entire building, and he's giving you a peek into the office that you may get to join him in as you file your tax return for 2024. Kage, take it away, my friend.
Thanks for the introduction, John Mark. I don't think you could have gave me a better introduction myself. So we're going to go ahead. I'm going to share my screen here just to get started with this presentation today. I want to thank everyone for joining the webinar. I hope everyone had a Merry Christmas and is going to have a very happy New Year. Hopefully start off with a Buckeyes win against Oregon, but we'll see. It'll be a tough game. So yeah, what we want to start with today is, you're at the end of the tax year, looking at 2024 in the rearview mirror. As we come up to the upcoming tax season, what are some key numbers that we need to be aware of as we get towards our filing? What should we be giving our tax preparers, our CPAs? And towards the latter end of the conversation, we're going to look forward to 2025 and beyond as we look up some key stuff that's coming in 2025, as well as the expiring tax code. And we're going to give our general thoughts on that and how we think that's going to impact financial planning for not just 2025, but future years to come. So So just to start off with a legal disclaimer, all of our guidance and stuff we get today is based off current tax code. As the U.S. government, it's subject to change at any particular time. So this is its current advice as of today. So if there's something that does changes, we'll be sure to let you know and give you guidance as that all comes in. So to start off with 2024 tax year in review, some just key standard deduction figures that I always like to tell people as you're coming up on the tax season what to expect. The standard deduction for 2024 is $29,200 if you're married filing jointly. Single individual is $14,600. Your capital gains taxes, not much change from year over year, but you are still in the 0% tax rate for married filing jointly if your taxable income is below $94,000. And where that does come, nice for tax planning purposes, just not for this year, but next year, is if you're living on Social Security, you're retired, you're living on Social Security, and you're living off of some retirement funds, and you have to pull some money out, whether it's to repair the roof of your home or buy a new car, and you have to pull some money out of a brokerage account, maybe you have to realize some capital gains. With this 0% tax rate, it's a nice, efficient way to get you the funds you need without the tax burden of having to pay that 15% capital gains tax rate. So that's definitely where using our tax services and using your financial advisor is a key advantage for you, is because we can help you strategize to get that, maximize that as much of that 0% tax as we can and minimize your tax burden for that. So for Roth IRA contributions, you're allowed to do up to $7,000 if you're below the age of 50 and $8,000 if you're 50 or older. If your modified adjusted gross income is less than $230,000 up until April 15th, 2025. So sometimes if you're right on that, if you're working and you're right on that fringe of earned income, we recommend that we get your tax in-house, get that figured out so we're able to give you the exact dollar amount of contributions you're allowed to do to your Roth legally without having to do any recharacterizations. If you're on that fringe or if you're over that fringe, we're already doing the backdoor Roth for you. You and your advisor are working through that just to make sure that you're doing everything the right way so that you don't get that untimely IRS notice, when you're on your vacation or enjoying your summer. So the big thing is during tax season is if you feel like you're going to be close to those Roth IRA limits, if you don't use Whitaker-Myers tax advisor, I definitely advise that you do if you're a wealth management client. But in the case that you're not, be in communication with your CPA as they are preparing your taxes, because if there is a situation where you need to recharacterize your contributions, you're able to work with your financial advisor to get that timely result for you before the April 15th deadline. The child tax credit remains unchanged from last year. It's still $2,000 per child under the age of 17, and it's $500 for dependents between the age of 17 to 24 if it's a student in college or if it's another dependent that's living in your household. If you're above the income of $400,000 married filing jointly, that tax credit does start to phase out a little bit. So one thing to watch out for in the case of a working couple that maybe gets a large bonus at the end of the year is one recommendation we would like to tell you is not to factor in your children into your tax withholdings. That way, in the case if your bonus bumps you over $400,000, it doesn't screw up your withholdings throughout the entire tax year because you're factoring in receiving that child tax credit. So that's one thing that we would recommend to clients is that if you're at or close to above $400,000 and you have a bonus at work that you can't always predict, it's maybe dependent upon commission or how well the company does in that particular tax year, we would tell you not to factor in a child tax credit for your work withholdings. In the case that you do get the child tax credit, great, you get that money back. But in the case where you don't all of a sudden have a $2,000, $4,000, $6,000, $8,000 tax bill because of a bonus that was over what your expectations were. So it's a good problem to have, but still we want you to be aware of it as something that if you're always going to be around those thresholds, we always recommend it's better be safe than sorry with that because it's hard to change your withholdings in December to save your prior year 2024 tax earnings. So as we kind of talked about a little bit, some of the common tax issues that we see our clients have or see clients that join us during tax season have is that maybe during the current year you have a big raise at work, you're killing it, you're doing a great job, but one of those things is you've been doing Roth contributions and now all of a sudden you're above that $230,000 max modified adjusted gross income limit we talked about, and now we got to pull money out of the Roth and put it into a traditional and do all that. So that's one common issue that we see sometimes that happens. The ways to work through that is first, make sure your CPA is doing their due diligence to make sure they're telling you timely that if you're over that limit. But throughout the year, if you know that you're getting a large raise at work and you're worried that it's going to put you over any of the thresholds, contact your financial advisor so that you can start working on getting this resolved in June, July, August, whenever the raise occurs, because it's paperwork that we can get done now. We don't have to get done during the rush of tax season, and it just makes your filing process a lot smoother. So maybe something to always bring up with your financial advisor during your yearly annual review is just make sure that your income is in line with what both you and your financial advisor expect it to be, so they know if you're going to be above any Roth IRA contribution limits, that they're able to help you, give you avenues to resolve that, and so that you're still able to get that post-tax savings that you want in those retirement accounts. If you're in a case where your workplace doesn't offer any type of health insurance and you're on a government health insurance plan, your healthcare subsidy is actually based off your projected amount of income for the year. So again, in a situation where you have an unexpected work bonus or a higher than normal work bonus, it's a nice benefit to have, but the downside of it is it can actually affect the amount of healthcare subsidy you're supposed to receive throughout the entire tax year. So we always tell clients that are on marketplace healthcare plans, be diligent and conservative with how you estimate your earnings to be for the year, because that's ultimately what determines the amount of subsidy you get from the government for your health insurance. If you pay too much in health subsidy, they will give it back to you in the form of a tax refund on your personal tax return. So you don't lose the dollars if there is subsidy that you could have got that you didn't get. But on the flip side of that, if you get too much subsidy, you have to pay that back during tax season. So again, if you're not watching your income and you have a large jump that you are basing your marketplace plan off of, it can cause a surprise tax bill, and no one wants to talk about a surprise tax bill during tax season. That's my most stressful call during tax season, so we do everything in our power to make sure you guys are well informed and you're making the right decisions, so that when it comes time to tax filing, it's just the nuts and bolts of getting your taxes filed, and we're handling all these planning situations for you during tax season, outside of tax season. And tax season is, just as simple as getting your taxes filed. And if you're retired and, maybe you got a house down in Florida, you're going down to Florida for the winter and getting away from Ohio. It's 60 today, but I don't know what it'll be a week from now. I'm sure it'll be snowing and sleeting and hail. So, definitely enjoy that warm weather a little bit while you're down there. The other thing is too, if you're 2024, some changes, you might open up a new investment account. Is that making sure you understand what the tax implications are of any new investment accounts you open with your financial advisor. So if it's a brokerage account, we want you to understand that there's going to be a tax reporting requirement associated with that brokerage account. Again, if your financial advisor and your tax advisor is both Whitaker-Myers, we're helping you handle that. But in the case if you're a new client that comes on, your old accounts or any accounts you hold outside of the Whitaker-Myers umbrella, you have to provide us with that tax information during tax season. So just definitely understand what type of account you're opening during the year so that you can be well prepared on the information to get to your tax provider during tax season. Charles Schwab and Fidelity both like to issue their brokerage 1099 statements during mid-February. So that's the earliest you can expect to receive those statements electronically to be able to file your taxes. I'm not sure about outside firms like Morgan Stanley and others, but usually mid-February is when most brokerage statements, tax statements are available. So that's just another date to have in mind as you get ready to file your taxes coming up on the season. And the last one we kind of covered is, making sure that your work withholdings make sense. So things that can change that is if you have a child that goes from 17 to 18, your tax credit for that child goes down from $2,000 to $500. So making sure if you factor that into your work withholding is that you're reducing your amount of child tax credit that you're expected to receive, so you don't get that surprise $1,500 withholding bill on your taxes when you file in April. So always the big part is switching that mindset from being tax reactive into tax planning. And the primary difference is just saying, hey, if you know something that's going to come up to change your financial situation, the best thing you can always do is reach out to your financial advisor and your tax preparer to say, hey, I have this life change coming up. How does this impact me? Should I change my work withholding? Should I do X, Y, Z? And as a tax preparer and as all the financial advisors on the call here, we're able to help guide you to get you to where you need to go so that, again, tax season, there is no surprises. You should know what to expect as far as tax owed, tax refund, and it's more of just actually getting your taxes filed and getting over that hump and making it as smooth as possible for you. So big thing is, as you get those increases in work, again, we help clients review their withholdings throughout the year so that if there is a change in your situation, we're able to say, hey, you're on track to get a $1,000 refund, or hey, you're not withholding enough, you're going to owe $2,000. Let's set up your withholdings to be a little bit extra this year to kind of nip that in the bud and get as close to zero as possible. Again, we kind of talked about the marketplace plan, so I won't go over that again, but you just want to make sure that any changes in income, for better or for worse, that you're updating your marketplace plan so that your premiums will adjust with that change in income. So even if it's a little higher monthly than you were thinking, the benefit is that you're not going to have to pay back that subsidy during tax season, and you don't spend the money that you're going to have to pay back later. We kind of talked through that. So 2024 tax deadlines coming up. Nothing's really changed from here as from previous years. Your individual returns are all due April 15th. If you're a business that has a Form 1065 or an S corporation, those are due March 15th. If you have any 1099s or W-2s that need to be filed as a business, those are due January 31st. And the estimated tax payment schedule this year is April 15th, June 15th, September 15th, and the following January 2026, January 15th. So any IRA contributions, recharacterizations, or corrections are due by April 15th, 2025. If you are a wealth management client and you don't use our tax service and you want to report to your tax preparer what your contributions were to your Roth IRA or to your traditional IRA, your monthly statement from Charles Schwab for your IRAs will tell you what your year-to-date contributions are. So you do not need to wait on the form 5498 that Charles Schwab posts May 15th. Unless you make a correction during tax season, at that point, make sure you reach out to your financial advisor and they can help you confirm what the exact amount of your contributions were. But if you're making monthly contributions year over year and you're not changing anything, your December statement will always have your year-to-date contributions through December 31st. So you don't have to wait until May to file to report your IRA contributions for the year, whether that be Roth IRA or traditional IRA contributions. So that's kind of the limit for, kind of the year end for 2024. As far as the tax laws go for 2024, not much has changed. They didn't add much of anything. With the election in 2024, not many laws passed, as most of Congress was kind of in a standstill waiting on, how the different Senate races, House races, and ultimately the President-elect Donald Trump being reelected into office. There was not many tax laws passing in 2024. So before we jump into 2025, I'm going to look through the chat here and go through a couple questions here. So there was a question: if you have a jump in revenue in December, what is the cutoff for adding to your IRA? Should you add it to the regular IRA or the Roth IRA? So your contribution deadline is always going to, for the tax year 2024, is going to be the following year, April 15th. So you would have until April 15th, 2025 to make a contribution for 2024. As to whether you should make it to your regular IRA or your Roth IRA, it kind of honestly depends on your individual tax situation and what you're wanting to accomplish. With us being a Dave Ramsey associated firm, we're huge on Roth IRA contributions if you're able to do them. With the Roth contributions, you pay the tax now, but you ultimately get the tax-free growth down the line. So the younger you are, the more definitely we're going to heavily lean towards a Roth IRA contribution because you get the longer tax-free growth. But again, if you have a very high income situation, it may be more beneficial to do a regular IRA contribution if you don't have a workplace 401k plan that you're able to contribute to. Let's see, I think there was one more question here. So if you are an LLC, can you write off the cost of your dental medical insurance and the cost of the policy? So yes, if you are a self-employed individual, you are able to take a self-insurance health deduction as long as you have enough profits from your LLC or business to cover the cost of your premium for your dental and medical insurance. Any cost for deductibles or out-of-pocket costs would go against your Schedule A itemized deductions, go towards that standard deduction. But as far as the actual premium, as long as your workplace, that if you're doing it as a side job or full-time, if it's your full-time business, you are able to pay, right off the medical insurance if you are a single member LLC. It doesn't go on your Schedule C. It's a separate tax form. Goes against a deduction on your tax return, but you are able to write that cost off if you're self-employed and are profitable. So I think that's the two questions we have right now.
Hey, Clay, excuse me, Kage.
Yeah.
We've got a pre-submitted question before the call. I'll just ask it to you here. Yeah. And we had a listener that asked, my income varies from year to year. They've got W-2 income. They've got a rental property with income. Of course, their investment account is kicking out capital gains and dividends. And now this person is also on Social Security. So one of our questions is, how would I go about setting up and sending in my quarterly payments to the IRS so that I don't get a late pay penalty from them?
Yeah. So the big thing, how a lot of estimated payments are calculated on the following year is once you have 2024's tax year is where we would be able to help you look forward to 2025. Those payments can be made electronically online, or our tax software actually has the option to where we can help you automatically set up the payments electronically for you, and it comes out of your bank account directly. You can do paper vouchers in the mail, but those have the opportunity to get lost or stolen in the mail. So we try to push clients towards electronic payment if possible. It's a very easy process to do. The big thing is with your income jumping from year to year is we got to have a starting point to know kind of what you think it's going to be, base your estimated payments off that, and then if there's something in your particular situation that would cause your income to either greatly increase or decrease, we adjust those payments as needed. If it's something that's going to be increasing your income, we would say, okay, on top of our those 4 scheduled estimated payments, let's go ahead and do an additional one once the extra income comes in to make that payment. There's no limit on the amount of estimated taxes. The IRS is not going to yell at you for sending more than 4 estimated tax payments to them. They will get more upset if you don't send any estimated payments to them. So the big thing is, as long as are able to estimate what your interest and dividends are from your investments, that's something your financial advisor can help you track, is when you sit down and do your annual financial plan meeting with your financial advisor to say, okay, this is about what we can expect in income for the year. That's where the financial advisor can work with me or your other tax preparer to say, okay, this is what we should be withholding for taxes as quarterly estimated payments for the year. With that.
Perfect. She also had a follow-up question. Since this is our first year of getting Social Security, wanted some clarity on how is Social Security. I think this is a great question anyway, because it is very unique. How is Social Security taxed? Is it taxed like passive income? Is it taxed like W-2 income? How am I paying tax on Social Security income?
Yeah. So a Social Security income is taxed as it's kind of a hybrid. It's not earned income in that you don't have to pay Social Security withholding tax or Medicare withholding tax on it. It's not taxed like passive income in that it's not subject to net investment income tax like interest and dividends would be. And it's also not taxed at most state levels. How Social Security is taxed at kind of depends on your particular situation. So if you are just a retired individual collecting Social Security and that was your only source of revenue income, you would have no taxes on your Social Security. If you were a married couple collecting Social Security and you had up to $25,000 that you were collecting from either interest and dividends, part-time working, retirement accounts, whether that be through a pension or your 401k or your IRA, you're collecting on you're taking RMDs, then half of your Social Security benefits become taxed at, half of it becomes taxed 50%. at whatever income rate you fall into during the tax year. So that can be 10%, 12%, 22%. If your income gets above another range, the max you'll ever be taxed on is 85% of your benefits. And that's something when you're, getting towards retirement, you're starting to collect Social Security, is where you want to sit down with your financial advisor and your tax planning to look to see how you're, what threshold are you going to be in. What I would tell clients is if you're collecting on a traditional pension or traditional IRA, 401k plan, you're taking distributions out of that monthly, plus you're collecting Social Security, plus you're working part-time, I would tell you to expect 85% of your benefits be taxed. You are able to set up your Social Security for tax withholdings when you set it up initially. Some clients will do that, some clients won't. The big thing is if you're not going to do that, you want to factor in your Social Security payments when you do those estimated tax payments for the year.
And one final pre-submitted question, Kage. In a good, I think, again, another general question, whether it be making a mortgage payment on December 31st as opposed to January 1st, or paying my property taxes December 31st as opposed to January 1st. We had a client that said, I just bought a new house, property taxes are due at the end of January. Should I pay those in 2024 or wait till 2025 so I can utilize them for my 2024 tax filing? Which approach is better for me?
So this would come down to each particular situation. Right now, under the tax laws, your state and local taxes are capped at $10,000 for the purposes of itemizing your deductions. So if you're someone between your state taxes, your sales tax or state tax, whichever state you live in. If it's Texas, it's sales tax. If you're in Ohio, it's usually state income tax, plus your property taxes. If you've already hit $10,000 in 2024, I would tell you not to pay your property taxes until 2025, because you're not going to see any type of benefit of prepaying those taxes a year before. If you're someone that's always itemized your deductions because you're, really charitable, you've had a lot of medical bills for that year, and you have a high mortgage interest rate because you built a home or bought your home in 2023. Unfortunately, you didn't get the COVID rates when you bought your home, and you're already going to itemize and you haven't hit that $10,000 limit between your state taxes and your property taxes from previously, then that's a situation where I would tell you, yeah, go ahead and prepay those taxes before the end of the year so you can get that additional standard deduction, itemized deduction to get to that $10,000 cap for 2024. The one thing that has been talked about as we kind of go in here into 2025, one thing that people did not like with the new tax laws was limiting it's called SALT, state and local tax deduction, to $10,000, because if you live in a high income tax state like New York or California, you really got screwed off that limit because you pay such a high amount of state income taxes that you can't take advantage of paying a higher state income tax rate to get that tax break off your federal tax deduction. So that's one thing that has, as these tax laws are set to expire, that folks have been talking about, is possibly removing the limit or increasing the limit for the state and local tax deduction. So if you are someone that is extremely charitable, you have a high mortgage interest, and you're above the standard deduction limit, you definitely want to look at if you're able to kind of, the same thing as we're going to get to, kind of lumping in your, charitable donations into one tax year to get a higher tax deduction. You may limit your property taxes, get 2 years of property tax deductions if you have the cash to get that higher tax deduction, if there's going to be a year where you can, take advantage of the itemized deduction. But I think that answers all those questions for now. If anyone has any more questions, feel free to put them in the chat. We'll have a Q&A before the end of the session. So if you have additional questions, we're happy to answer them. But we're going to hop in now to 2025 tax planning. So first, again, quick, update on the standard deductions for 2025. It's up from $29,200 for married filing jointly to $30,000. So not nearly as high of a jump as it was from 2023 to 2024. And partly is because inflation has come down from what it was from 2022 to 2023. So they kind of didn't raise it as much because of that. Capital gain bracket, slight increase from 94,000 to about 97,000 for your 0% tax rate there. So as we go into 2025, what are some things we would tell clients? What do you need to be looking out for? The biggest thing to look out for is the proposed tax law changes. So as President Trump takes office here on January 20th, 2025, he's going to have a lot of things to get fixed and start working on. One of the things that they're going to be working on throughout 2025 is either extending the Tax Cut and Jobs Act or replacing the Tax Cut and Jobs Act. And since President Trump was the one who put in the original tax laws, a lot of the tax laws are going to remain the same, or even extended or made permanent, which for our perspective is a very good thing, because he did some very favorable stuff as far as increasing the estate tax deduction up to $13 million and making that burden a lot less burdensome on a lot of individuals. So we would see for a lot of that stuff to be extended. There might be some additional things that they've talked about on the campaign trail that we'll get into further that could be beneficial to retired folks and working folks alike. If you're hitting RMD age, make sure you're reviewing your RMD requirements on all your retirement accounts. If you are a Whitaker-Myers Wealth Manager, a client, they send out your RMD letters in January, February, so what you need to take out of your retirement accounts. And the reason why you want to review your RMD requirements is that outside of RMDs, if you're not needing those funds, there are tax advantage ways to use that RMD so that you don't face a tax burden and you're able to be charitable with that. You want to review the tax diversity of your tax investments. So if you're someone that's just retired and you're very heavily in pre-tax funds, one thing you want to look to start to do and talk with your financial advisor about is the idea of Roth conversions, so that we can start to balance out your pre-tax funds with some of your post-tax funds, so that we can lower the burden of your RMD requirement once you reach your required age. Other things, if you're younger, what do we mean by reviewing the diversity of your tax investments? Is, does your company offer a 401k match? Are you doing Roth IRA contributions? Are you hitting that 15% that Dave Ramsey wants you to be hitting, saving for retirement? How are you hitting that? Are you hitting that through 401k and Roth IRAs? Are you contributing to a brokerage account that satisfy that limit? And all those different accounts have different tax situations, and they're all advantageous in their own ways, depending on what you need. And the last part, which Tim will get into, I'll kind of hand it off to Tim once we get there, is reviewing the timing, method, and how much you're charitable giving through a donor advised fund and methods of that nature. So when we talk about the tax law changes that are coming in 2025, with the reelection of Donald Trump, like we said, we can expect a lot of the tax laws to stay the same, not only because he won the presidency, but they won a 2 to 3 seat advantage in the Republican Senate, and they hold the majority on the House of Representatives. So we could look to see a lot of these tax laws to be extended. Some other provisions, some of these beneficial provisions that they added was a lower corporate tax rate. They lowered it to 21% down from a much higher rate under the Obama administration. The increased standard deduction and removal of dependent deductions at the federal income tax level, that made tax filing a lot simpler, and if you have a larger family, you may have seen a little bit of a tax increase there, but for most families, it was actually more beneficial. And the big one is the increased estate tax deduction. It made that estate tax much higher threshold to hit before you're crossing that threshold. So some of the things that President Donald Trump had kind of run on, and some of the ideas he had thrown out in changing the tax code, was one, he wanted to further decrease the corporate tax rate from 21% to 15% for companies that manufacture their goods in the United States. One thing is that's nice on that is the lower tax burden for corporations usually, in some cases, translates to a lower cost of goods. So you're paying a lower price because the taxes aren't as high. So that's one of the things that can help to bring down some of the cost of your grocery bills and other things of that nature. We touched on it a little bit earlier, but that $10,000 limitation on the state and local tax deduction, that's a big one for high income earners that pay a very high amount in state income tax and local taxes. And if you're in Ohio, you could have, local tax, you can have state tax, local tax, school district tax. It's all over the place. So by removing that $10,000 limitation, that could save you some additional tax dollars if you're over that threshold. A big one, and we don't know if this will pass or not, but he talked about the possibility of eliminating income tax on Social Security benefits. That would be huge for retired folks, is because if Social Security benefits are no longer subject to income tax, chances are that may or may not be factored into your net income, into your income when you're looking at doing Roth conversions or looking at doing other contributions. So you may have more room available to do Roth IRA contributions or conversions if you're someone that wants to lower your RMD requirement before you hit 73 or 75, depending on your age. So the one thing I always tell people and stress people, as you're watching the news and you're seeing as they start talking about the tax bill, the first version of this tax bill that gets proposed is not going to be the final version. So don't see something in June that's on the initial tax bill and think that's going to be what passes in September, October, November. Just be diligent. Our firm will do its best to update you as these, proposals are made and as amendments to the proposals are made, so you guys have the up-to-date information on that. Any tax law changes will probably not be effective until tax year 2026. They may retroactively make it effective for 2025, but that's not something we would know until we get, until that final bill is passed and they've, made that determination or not. Big thing with reviewing on your RMD requirements, beginning in 2023 last year, is that your RMD age was now 73 if you were born after December 31st, 1950. Your RMD would now be 2025. So the big thing is always talk with your financial advisor when you're getting close and you're at that RMD age, so they know they're calculating for you how much you should be taking out of your investment accounts each year to satisfy those requirements. Each your inherited IRAs, if it was before or after 2020, will have a RMD requirement if you're not a qualifying individual. So all of your separate accounts that are subject to RMDs have their own RMD requirement, but you can take all of those funds out of one particular investment account. So you don't have to take, if you have 3 accounts that are subject to RMDs, you don't have to take it out of each account. You can take it out of one account as long as you satisfy the requirement for all your accounts in a given tax year. So as you're talking through RMDs through your advisor, one thing to mention to your advisors is if you're giving to your local church and you're subject to RMDs, one thing you might want to consider doing is changing your tithings to come through your required minimum distribution, because by doing what's called a qualified charitable distribution or a QCD, you are able to remove the income tax burden on your required minimum distribution out of your IRA account, and it becomes tax-free because the money is being taken out of your IRA and given directly to the church. So that's a way to save your cash flow if you were originally giving those funds to the church out of your Social Security you're collecting each month, or giving it out of your, monthly distributions you're getting out of your accounts to begin with. So it's definitely something to think about as you hit those RMD limits, is to look at if you're being charitable and you're donating, is just how exactly are you donating to your charities, because there is a more tax efficient way. And we don't always look at when we're donating to a charity for the tax benefit, but we definitely want you to be thinking of that, because there's no point in paying a tax on something you don't have to if there's a more efficient way to do it. And we kind of walked through this example here a little bit for you. We walked through a similar example last year. The big thing to remember is all standard charitable contributions are compared to against your itemized deductions, which for 2025 is $30,000. So if you're someone that's retired, that has no mortgage payment, that is blessed to not have medical bills, you're going to have to donate $30,000 in charitable givings if you don't have much state and local taxes to even get to the standard deduction limit, let alone be above that. So to think about it in terms, you would have to give, if you gave $35,000 to charity and you had no other stuff to help you itemize your deductions, your tax benefit for that deduction would be $5,000 because the IRS gives you $30,000 off the bat. But if you are someone that gives $30,000 a year and you just become subject to an RMD that's $30,000 for the given tax year, you could, through your IRA and through your financial advisor, do a qualified charitable distribution to your local church of $30,000 and take that $30,000 completely off your tax return. You don't have to pay taxes on it, and you still get the benefit of the standard deduction. And you save that monthly cash flow so that it's not coming out of your monthly Social Security and stuff. So it's definitely a game changer once you hit that RMD age to start doing your qualified charitable distribution through your retirement accounts. And it's one of the reasons why we tell folks that it's not a bad thing to have pre-tax money in retirement, because if you are going to be charitable and you are in, baby step 7 and you're living and giving like no one else, it's definitely a good way, a tax efficient way to be charitable, make a difference in your community, but you're doing it in a way that's not only beneficial to the charity, but it's beneficial to you as well. And then as you're retiring and as your folks working towards retirement, it's always important, we tell you, to look at the diversity of your tax investments. So your individual advisor helps you pick out your funds to be invested in based off your individual living situation. So there's, diversity of investments. Am I in cash, or am I in, ETFs, mutual funds? Am I in some other real estate fund? What's generating my return? But you also want to kind of have that mindset when it comes to the diversity of your tax investments, whether that's, do I have a Roth 401k? Do I have a Roth 401k with a company match? Do I have a Roth IRA? Do I have a brokerage account? And why that's important is because just as it is in retirement to have different sources of avenues, when those situations come up in retirement where you have large situations that happen, whether you need to buy a new car, your roof needs replaced on your house, things come up, you have a medical bill that you can't pay for and you have to take money out of retirement to cover it. What account you take that from depends on how you saved. If you're someone that's only saved in pre-tax money all your life, well, you're going to have to take that hit, out of your 401k to pay that. But if you're someone that's not only saved with a 401k, you've got a Roth IRA, you've got a brokerage account, now you can really start to say, all right, do I take some money out of the Roth this year so I don't have to worry about the tax hit? Do I take some out of the brokerage account because I'm in that 0% capital gains tax bracket so I can sell some investments, get the cash I need, but not pay any income tax at all? That's where the diversity of your tax investments really matters. And if you're doing it at a much younger age of diversifying between pre-tax dollars versus post-tax dollars, you already take the additional step of lowering your tax burden for that date comes when you're subject to required minimum distributions. Because one important thing to remember is that Roth 401ks and Roth IRAs are not subject to RMD taxation. So it's not subject to income tax when you take the money out. So we definitely tell you the younger you are, you definitely want to be saving in a Roth because you want to pick up that 30 years of investment-free growth. But you also, if you're getting a company match, you want to have some pre-tax dollars so that if it comes time when you do have RMDs, if you're giving to your local church and you're giving to charity, that you can give it through those RMDs and not have any additional tax burden and still save that monthly cash flow for you in retirement. And then just a quick summary again on the investments. As far as contribution limits for 2025, one thing that did change is that if you're between the ages of 60 to 63, you're actually able to do a higher catch-up amount to your 401k for those 4 given years. So instead of a normal $7,000, you can do $11,250 if you're between the ages of 60 to 63 and you're working in your 401k. So if you're 50 to 59, it's $7,000. If you're 64 or older, it's $7,000. But if you're between the ages of 60 to 63, you can do a catch-up of $11,250. So definitely be looking at that if you're someone that's looking to do some catch-up in retirement to get some additional dollars in there prior to retirement. If you're in that 60 to 63 age limit, make sure if you're able to take advantage of that additional catch-up, because that's something they added to be effective this year. So I'm going to give a very broad overview on this, and then Tim, I'm going to turn it over to you here for the last part of the thing here. But reviewing the timing, method, and amount of charitable giving, I don't want to speak for everyone on the call, but I think John, Mark, and Tim can definitely speak to this. One of the greatest feelings that you can have as an individual is not always your own accomplishments, but what you're able to do for others. The opportunities you're able to afford to others and watch them take advantage of it. And just, you feel much better. Some of the best stories, fondest memories that I have is not what I've accomplished on my own in my life, but what I've done for someone else, what I've helped someone else do. If you've played any type of sports in high school, college, collegiate level, or even at the Pee Wee level, you feel much better when the team wins. Not necessarily did I score 30 points or did I score 5 points, but the team won. And that's when I think of charitable giving. It's giving back to your local community. It's giving back to your church, whether that even be donating cash or donating time. Your greatest return on life is what you do for others. So when we look at it from a tax perspective, we want you to be able to give freely and willingly to these endeavors in a manner that not only benefits the charity that you're wanting to benefit, or the local community that you wanted to benefit, but we want you as the donor to be able to feel the tax benefit of that in a way that hopefully drives you to continue to give. And the amount and timing of those charitable donations can vary over your lifespan, depending on whether you get large bonuses at work, whether you have large sums of money from an inheritance or a business sale, or if you just have really high income levels and you're always itemizing your deductions. And at that point, I'm going to turn it over to Tim here, because Tim's going to walk us through a situation where a donor advised fund would make more sense to do lumping your contributions in a given tax year to that. So Tim, I'm going to stop sharing my screen here if you want to take over.
All right. Yeah, thanks. So Kage is a CPA. I am a CAP, Chartered Advisor in Philanthropy, as well as a CFP. I got that CAP designation because I not only, just like Kage was saying, I'm a Christian. I appreciate the impact that giving myself can have, but I also want to help you save taxes while you're giving. So why not do that in a tax efficient way? I've worked with some people that have felt a little bad playing some of these tax games, but the reality is, why give any extra dollars to the government that we need to, and keep all the dollars ourselves? Or if you save some money on taxes, give that away as well. So I'm going to take you through a couple examples on how to use a donor advised fund to save money on taxes while giving. A couple quick things that we already talked about, though: that qualified charitable distribution, QCD, that is available at age 70 and a half. That's the old RMD age. Of course, the RMD age has ticked up to 73 now, but you can still do that QCD starting at 70 and a half. So keep that in mind. Even if you're not hitting RMDs, you can utilize the QCD at 70 and a half. Get money out of your IRA without paying any taxes, and reduce your IRA balance, maybe reduce future RMDs. Another thing is that question about, should I put money towards a traditional or a Roth? Very good question. And obviously the answer is it depends. And some of the things it depends on is your age. So are you getting close to retiring and moving from saving taxes when you put money into a traditional and taking that out maybe at a lower tax bracket? So if you're a little bit older, I'd say 55 and over, a traditional might actually make sense if you can save money, especially if you're in a higher tax bracket. Save money now, and in just a few years, pull that back out at a lower tax bracket. But certainly for a younger person, in a lower tax bracket, we lean towards Roth, and you can contact your financial advisor to run some projections for you. So I'm going to talk about the donor advice fund and share my screen here and take you through a couple examples. Let's see here. All right. Now, this is a Schwab white paper talking about donor advice funds. And a couple things. So this first example, this individual had purchased stock that has gone up in value a lot, tenfold. She purchased stock for $5,000. It's now worth $50,000. And obviously, that's a good problem to have. And she's philanthropic, so she wants to give some of this money away. And there's two options. So the first option is to sell the stock outright, where she would have to deal with some long-term gains and pay taxes on those gains. And option one is here on the left-hand side. She sells $50,000 worth of stock. She has $45,000 in long-term gains that she has to deal with. And she's in the 15% capital gains bracket. So she ends up paying $6,750 in taxes on that. And then she gives the rest to charity. So she's donated $43,250 to charity. And that represents in her tax bracket a tax savings of $3,630. Now, the other option, which I think is a much better option, is to actually donate those appreciated shares to charity. Now, you can either give those directly to charity and realize $50,000 worth of a tax deduction, or you can do the exact same thing and move those shares to a donor advised fund, and you obtain the same tax privilege. You get $50,000 of tax deduction moved into a donor advised fund, and the minute that you do that, you realize that deduction. So she can now deduct, instead of $43,250, she's able to deduct the whole $50,000. So it's actually the fair market value of those shares at the time of the donation. So she doesn't get a $5,000 deduction. She gets a $50,000 deduction. And so she's already realized $6,750 more of a deduction. She's given away $50,000 instead of around $43,000. And she saved a ton more in taxes. So donating funds or appreciated shares to her donor advised fund can give you more bang for the buck. Don't sell the stock and then give cash to your charity. Give the shares away or give them to a donor advised fund. And one of the nice things about a donor advised fund is, instead of dropping 50 grand on a church, for example, where they might not know what to do with that amount of money right away, they might not be able to space those funds out over time, you're able to direct those funds over time. So you can move money from your donor advised fund, and you're still in somewhat control of those dollars. And you can make grants from your donor advised fund to the charity on a monthly basis, or every quarter, or every so often. You can direct funds from your donor advised fund to the charity, and makes it a little easier for the charity to handle in that way. Here's another tip. If she liked this stock, let's just say it was NVIDIA stock, and we all know NVIDIA has appreciated greatly in the last few years. And let's say this individual still wants to have the same number of shares of NVIDIA stock. Well, she can donate $50,000 worth of that stock to her donor advised fund and not have to deal with realizing those gains. And she can turn around, if she has the cash, buy $50,000 worth of NVIDIA stock in her brokerage account, have the same amount of shares, but she's removed a lot of that taxable gain from her account. So just some very tax efficient ways to handle that. Let's move on to our next example. We've already talked about this. Kage has talked about this, but this is tax bunching, or tax looping, some people say. So the standard deduction in 2025. Yeah.
Can you share your screen real quick? There was a couple people in the chat that weren't seeing your seeing the example you were talking about there.
Thank you. Let me make sure I'm on there. I didn't push the share button. There we go. Thank you for letting me know that. Let me just back up here real quick. So here's the appreciated stock and just a quick example. So if she had sold $50,000 worth of stock, she would have had pay this much in gains, donated around $43,000, and her tax savings was around $3,600. Option 2 was moving that to a donor advised fund, and she'll get the full $50,000 worth of a tax deduction. All right. Moving on to our next example, we talked about utilizing a donor advised fund to maybe you're giving close to the standard deduction, but you're not over the amount where you can actually itemize. So in 2025, that standard deduction for a married filing joint is $30,000. So if everything that you're itemizing include charitable deductions is not $30,000, you're not getting credit for making those donations. So something that you can do with a donor advised fund, and this is an example of a couple giving away $10,000 a year to charity. You can see on the left-hand side of your screen, their $10,000 plus their other deductions is not going over that standard deduction limit. And it's not that they don't want to give funds away. They do donate that $10,000, but they're not getting a tax credit for that. So what they've done in this example is they've taken 2 years worth of donations and put that in a donor advised fund in 1 year. So instead of $10,000 a year, they've put $20,000 into a donor advised fund in 1 year. They get a bigger bang for their buck. So hypothetically in this year, this is back in 2023, but they've donated $20,000, $13,000 in other deductions, and now they're over that standard deduction limit, and they're getting a good break there, and they're able to deduct those donations. The next year, even though they're not giving money yet, and I'll explain a little bit how we can space that out, they still get that standard deduction. So with this huge standard deduction, it makes a lot of sense to try to bunch your donations over 2 years into 1 year and put that in a donor advised fund. And like I said earlier, that $20,000 doesn't have to go immediately to your charity. You can space that out. And in fact, in your donor advised fund, you can invest those funds and have those grow potentially with the market. And you actually get quite a bit more of additional tax deductions when you do that. And then finally, our last example, this is somebody who wants to do, let me make sure I'm on the right screen here. That was a qualified charitable distribution. This is somebody who wants to do a Roth conversion. So she wants to convert $100,000 of her traditional IRA to Roth. But of course, when you do a Roth conversion, that $100,000 is included in your taxable income. So you're going to pay more in taxes. Well, this individual had some appreciated stock in her brokerage account, and she also wanted to give that away anyway. So she lined the timing up of her Roth conversion. She converted $100,000 from her IRA to her Roth, which resulted in about $24,000 more of taxes. But then the same year, she donated $100,000 of her appreciated stock, which provided that exact same amount of deduction. So she's able to make a significant Roth conversion, move funds into an account that's going to grow tax-free and provide that diversity like that Kage talked about. But she didn't have to pay any taxes because of her contribution to a donor advised fund. Another nice thing you can do with a donor advised fund is make it a family occurrence. So you can set up your fund. You can name it what you want. I might name mine the Hilterman Family Fund. And every year, get the kids involved in directing where those donations might go. And that's something actually you can pass on for generations. You can set it so your donor advised fund, when you pass away, will actually the control will transfer to your children, and they can carry on that legacy and maybe contribute to that same fund and continue that into the future. So those are just some ideas for you. Hopefully that sparked some questions for you. If you have anything coming up from the chat, feel free to drop it now. And otherwise, you can reach out to us if you have any questions.
Yeah, great job, Tim. The one thing I would add too is that there are technically limits to the amount of charitable contributions you can give towards itemizing each year. So for cash contributions, that is 60% of your adjusted gross income. So if you're a $100,000 income earner, the max amount of charitable deductions you could take that year is $60,000. If it is appreciated, like stock or other things like that, it is subject to 30%. So that's things your financial advisor would know. And as you're looking to give that donated stock, we would make sure that you're within those income limits or those AGI limits to make sure that you're getting the full credit for the charitable deduction in that given tax year. John Mark, do you want to add anything here on the end of it?
No, I think, yeah, you guys both did a great job. This video will be put on our YouTube page sometime this evening. So if you want to replay it at all, you certainly will be able to go there. Kage, maybe we did have a few questions that hit the chat. We won't be able to get to all of them, but we will email the folks with a response back from you. But maybe one that you could end us with a question to end 2024, the definition of head of household, and does a single person qualify for that? Why don't you take us out with that question right there, Kage?
Yeah, so a single person can qualify for head of household. Head of household is determined as you're taking care of someone else. So you can be a single mom that's still taking care of one of your children in the house, and you qualify for head of household. But you have to be taking care of either a qualifying dependent or a qualifying other dependent, and you're providing more than 50% of their living expenses, care, such as things like that. So let's say if you're, someone that's taking care of your parents move in with you, they're getting towards retirement, you don't want to put them in the retirement home, they start living with you, and you're, providing more than 50% of their day-to-day living and stuff, then you can claim the head of household and claim them as a dependent. The big thing is if you are in that situation where it's an elderly individual, for example, where the son or daughter is taking care of the parent, if the older individual parent still has a filing requirement themselves, they need to make sure that they mark on their tax return that they're claimed by someone else as a dependent on their tax return. So that then doesn't draw a red flag with the IRS on your tax return when you're claiming the head of household and you claim them as a dependent. Just because a child files their own tax return, whether that be because they crossed over an income limit in college or they had income tax withheld, does not mean they still can't be claimed as a dependent on the parent's tax return. You just have to be able to prove that you're providing more than 50% of their living expenses and they live with you. Or in the case that they're at college, there's an exception if they're at college for half the year, that they're living in your household for at least 6 months out of the year. So you can be a single person and claim head of household, but you have to have that qualifying dependent, and you have to meet all those additional standards for that.
Yeah, wonderful. Well, Kage, you are the head of household for our tax service, and we appreciate you for that. And Tim, you are the head of household for our planning, so we thank you for that. This was a great conversation and one that I think we all took a little bit from. If you have any specific questions relative to your situation, don't hesitate to reach out to your individual financial advisor, as both Kage and Tim said. They'd be more than happy to analyze, look at your situation to help you think through any of your tax situations for 2024, 2025, or as we get our Jobs and Tax Act update sometime this year, probably, we will certainly be ready to discuss that with you. So thanks again. We'll look forward to seeing you at next month's webinar. Have a great day.
Thank you.